Well, with US CPI and non-farm payrolls firmly out of the way, a Fed rate cut next week seems all but assured. If we look at markets, we can see the Nasdaq is in absolute beast mode at the moment, pushing all-time highs as traders flock into growth and high momentum plays, and they completely outperform. We're seeing good buying in gold, and that's starting to move a little bit higher. We're seeing crypto moving very strongly again. We've seen all-time closing highs in Bitcoin, but some of the other coins are in beast mode as well. We're seeing the FX markets, the US dollar is holding in pretty firmly, and we're seeing good gains against the Japanese yen and certainly against the Aussie and the Kiwi at the moment. There's a lot going on in financial markets, as there always is. Blake and I dissect the moves and show you how to trade it. Well, hello, I'm Chris Weston, the head of research here at Pepperstone. I am going to be joined in 2 seconds by Blake Murray from Forex Analytics, and we will be discussing the moves that are going on in these financial markets, what's going on with central banks, how that's translating into moves in FX markets, into crypto, into various markets as well. So there's a lot going on in the crazy world of financial markets, a lot of setups that they're focusing on, a lot of price action, a lot of flows, a lot of movers and shakers. So break it all down. I'm going to bring Mr. Blake Murray into the program. Blake, how goes it, my good sir? Are you well?
I'm doing well. You know, I learned a new term today, and I just can't wait to use it. But you know what I'm talking about. You
know what it's like. Every day, school day in the financial markets, you learn something new. But this is, I think, what we're referring to, and all the suspense. But I think it's something that's going to be very local to people down under. They'll understand. But the battler ain't battling. Anyway, let's bring it into topical thunder and let's see exactly what's going on in the crazy thematics in the market. Mr. Blake, I want to bring up the Nasdaq. I just use this as a proxy because what we saw overnight, and well, for me overnight, your daytime, was a CPI print, which came out core at 0.3%, pretty much in line with expectations. If you take out the basket of goods from the CPI calculation, I know we've got PPI tonight, and that will sort of solidify it. We've basically got core PCE tracking around 0.2% month for month, which is pretty much in line with the long run average. But now we've got a pretty good non-farm payrolls number, good headline job creation, an unemployment rate which ticked up a little bit. But yeah, I think all of those factors mean that the Fed is absolutely game on for a rate cut next week. The market wanted to see that, but we've taken out these two headwinds, these tail risks from the market, and of course people have just said, it's game on. Let's bid up risk. You know, Nvidia's pushed up higher. The Mag 7 plays have all done well. Amazon's not looking pretty strong. Tesla had a nice gain as well. But it's all about growth, high momentum. You know, the styles and factors in this market. People rotating out of healthcare, out of those value plays, back into the sort of the mega caps. And the Nasdaq is absolutely fine. We've got the S&P pushing all-time highs as well. But you know, I think the Nasdaq's the poster child. That's where we see most of the flow. So with these big hurdles out the way, I suspect the Fed meeting won't necessarily derail risk, but we could be, we'll have to watch that one. But, are we in the position now to, I know we're going to look at sort of game plan into markets on that last sort of docket, but I like chasing it here. I think that, the market's up 30% year to date. It's there for chasing now. What do you think?
Well, this is the conversation we had last week, right? And we were talking about, if you're an asset manager and you're not up 30%, do you have to chase? And I love also seeing rotation, Chris. If you look at like some of the big cap names and you look at the Dow 30, for example, it was down pretty good today with the S&P and the Nasdaq up, and that's just pure rotation. And you even see money coming back into the DAX. So you can see that asset managers are chasing the markets higher, and that is going to bring us to the fourth topic, which I don't want to get into just yet when we start talking about like the end of year game plan and kind of the other things that need to fall into place. But I don't like to chase. I don't like to chase in the markets. But at this point, you're kind of forced to, aren't you, Chris? I mean, a breakout's a breakout. Bullish is bullish. I look at the S&P. It's got a bull flag pattern. I mean, it's a bull flag pattern. It looks like we're going to all-time highs and then some. So
you and I don't know, I'm going to put words in your mouth, but I don't think we benchmark ourselves to an index, so we don't have to report, our performance. I think, for me, the only person I report into is my wife, and, make sure that I'm making some money in the markets. But we're not that active manager. We don't get paid a performance fee for outperforming the S&P, for example, or whatever benchmark you're tracking. So for me, it's more just about, is this market going to go up and do I want to participate? I think you raise a good point about the Dow. When you're choosing your index, you need to understand the characteristics of that. If growth is firing up, if people want growth, those the high earnings momentum, you've got to go. And the Nasdaq is the place to be. The Nikkei is also a good one there as well, and the DAX is pretty good. If you want value, if you want to go into those high dividend, high income stocks, ASX is the place. The FTSE is really good, and also the Dow. It also has a big weighting of banks and healthcare stocks. So you've got to know what makes up the index and its characteristics. But if Nvidia is firing up, if tech's firing up, AI and the Mag 7, the Nasdaq's the place to be, obviously.
That 100% is. All right, Chris, I'm gonna actually I want to talk about our next subject, which is the ECB, which happens to be tomorrow, and I think it's the other central bank that most everybody's watching. And next week is the Fed. That's the big kahuna. That's going to be the showcase central bank meeting, I believe. But tomorrow's a big deal too. And I want to point out what happened with today's Bank of Canada meeting. Bank of Canada, they did cut rates. They gave us the jumbo 50 basis point cut, but we saw the Canadian actually strengthen following that. Following it, they realized that they're probably going to front load. We're basically, you can use the term front loading rate cut, and they're probably going to be they're going to be holding rates at least for a little while. And I think when you saw the euro react today, originally the euro spiked up above 105 towards 105.30, but then you saw the rest of the day it kind of sold off. And I think, and I have this sneaky suspicion, the markets are probably looking at the ECB wondering, is the ECB going to be following suit? Now, there's a lot of reasons why the ECB should be cutting, and we could go, I'm sure you're going to talk about a few of those reasons. But also the fact of the matter is it did weaken going into the number. And like I said, I think markets were looking at the idea that maybe the central banks weren't going to cut as much in anticipation of what's going to happen in 2025, keeping some powder dry with President Trump coming back into office. The flip side is maybe they're going to front load everything, get it out of the way, and then sit on the sidelines. Do you have any thoughts about the ECB? Because I can't remember the last time we had an ECB meeting where we saw a rally in the euro afterwards, but my memory is not great like that. What are your thoughts here?
Well, you certainly come to the wrong place if you want a memory. I'm a shocker. I think with the ECB, I think JP Morgan's a really interesting one because every economist has got a 25 basis point cut penciled in for tonight. The market's fully discounting a 25 basis point cut. But JP Morgan have stuck their neck out and said, look, we're going 50 basis points because we think that's exactly what the ECB need. And if you have a look at the PMIs across the Eurozone, you can make an argument for that. Obviously, we're looking at the French budget situation, very precarious. We're seeing what's obviously happening in Syria. And there's a possibility we could see immigration coming through as a result. We saw that before. There's the whole sort of complex in terms of growth warrants a 50 basis point cut, but there's obviously a big difference between what should happen and what will happen. And they'll cut by 25 basis points. That's fully expected. The euro will rally or move based on the guidance and the appetite for them to ease aggressively going forward. And are we going to get closer to that trough point? Are we starting to identify that trough point, which the market price is at 1.75%? And I think that's the same in Canada. The faster they cut, the closer they're going to get, or the sooner they're going to get to that low point in the cutting cycle. And that's where you're going to see that cut, the Canadian dollar. So, when the market discounts an action, it's really about their appetite and the guidance for future cuts relative to the market pricing for upcoming meetings. So they'll cut 25 basis points. The question is do they indicate a greater desire to maybe go 50 basis points? They won't. But are they going to continue to see we're continue to push rates down? We've talked about it time and time again on this show, Blake. This idea that You know, the euro's at 105 at the moment. You could argue, given the data, given everything that's going on, that euro should be trading 102, 103 at the moment, but it isn't. And I think that tells you a lot about what's going on. It feels like the market wants to rally, but no one's prepared to act on it yet, to be honest. But maybe that's a story for 2025. But you know, buying euros with this growth dynamic is still very, very difficult, isn't it? Anyway, let's move on. But yeah, I mean, I think where's the balance of risk? We'll have to see. FOMC, let's chat this, because you know, if you ever look at the market pricing now, I think last week Christopher Waller, one of the most influential members of the Fed, basically told us that he had a strong desire to cut 25 basis points. The bar to cutting is very low. We got a slightly higher unemployment rate. That was okay. That was sort of said that, there's a good chance we're going to get the cut. We've seen the CPI number today. Look, 30 basis points on core month on month is not great, but if you take they set policy to the PCE deflator, and that suggests that we're probably running 0.2%, which gives them the ammunition then to cut. So in my mind, it's a done deal. They'll cut 25 basis points. So Nick Tamaras in the Wall Street Journal coming out of an article this morning, he's basically, he was the guy who was going to poo-poo the situation if it was going to happen. He hasn't. So they'll cut 25 basis points. Again, it's down to the pace of cuts going forward, I think, which obviously is interesting. And we're going to get the dots and the SEPs as well. So where do you see the balance of risk from the Fed meeting for the dollar and for equity?
I don't. First of all, I think they are going to cut 25. I agree with you. Today was the part of the ingredients that we needed for the next segment, which we'll talk about here in a second. But I do think the Fed's gonna be able to cut. Whether or not they continue to keep that door ajar for 2025 is really the question, right, Chris?
Yeah.
And so listening to how Powell frames everything next Wednesday is going to be extremely interesting. But it's also the end of the year, and I don't know how much disruption he's going to want to cause. And I think he wants to leave that door wide open going into next year, because we have a new president coming in, and we have President Trump, who would probably enjoy the Fed continuing to cut rates. And I think you want to keep hopes alive, right, as you go into 2025. So, Chris, I think rates continue to go down, even though I don't believe they should. But I think that they will, and expectations will continue to come down, and keeping the stock market very well elevated, and the dollar probably suppressed a little.
Well, I think if you go to the pricing in the swaps market or the Fed funds futures, the January meeting, we'll see the Fed come back on hold again. They'll leave rates unchanged in the January meeting. What's the next meeting after that? It's in March. They don't have a February meeting. So there's the conjecture. I think the market debate will move on pretty swiftly to the data and whether we get a cut in March. I think that's probably going to be one. They certainly won't cut in January. It doesn't seem like that's going to be possible. But we're looking more at a quarterly pace of cuts after that, and that's going to be driven by the data, by the labour market, by inflation, all that sort of stuff. And they may move quicker if the data deteriorates, but they're going to have that flexibility, and Powell will maintain that optionality as you talked about there. So whereas the balance of risk for me, I don't know. I mean, for the dollar, I think it's pretty much two-way. I think for equity markets, it shouldn't derail. I think you buy dips in the NASDAQ and it continues to go higher there.
Well, that brings us to our last topic, and I want to talk about the markets, and I want to talk about a kind of a game plan going into the end of the year. Today was the first piece of data that I think that investors needed to give us the green light. As soon as that CPI came in line, with expectations 0.3 on the headline, on the core, 2.7 on the year over year, that was like the thumbs up. Stock market's going to rally. Surprisingly, the dollar didn't respond as much as I thought it was going to. I actually thought the dollar was going to come under a little bit more pressure, but I think everybody's looking ahead into the ECB, obviously, as we discussed, going into tomorrow. But overall, the recipe that we have cooked up for the end of the year Santa Claus rally, because I know Chris Weston loves the term Santa Claus rally.
I'm gonna go and dress up as him next week, and surprise you all just with my love of this mythical creature. But
I cannot wait to see that. Okay,
I've got children, mate. You've got to believe in it.
I'm wearing my hat. All right, so next week, we do have the Fed, and if the Fed does what we're just talking about, they leave that door ajar for potentially early next year to have another cut. We get a 25 basis point cut next week. The game plan, I believe, is as you just pointed out, you buy stocks on dips, and the dollar probably continues to sell off. Then we have end of year flows, which is another. What happens after the Fed? Because if the Fed does do everything that we think, that should open the door for some end of year dollar selling, maybe portfolio rebalancing, dollar selling to happen. What are your thoughts as far as the end of year and how you're going to play it?
Well, I think an interesting way of looking at this, Blake, is the volatility markets. I mean, 20-day realized volatility in the S&P is about 8%, which is the lowest levels for since July. The VIX has come back, all different types, the short-term VIX and the classic 30-day implied. So equity volatility is the lowest level since July. It's come right back, and that's really positive for equity risk. People are buying upside calls, and that's just sort of perpetuating the move. Bond volatility, the MOVE index, is the lowest since early 2022. So with volatility so low, you've seen those volatility dynamic targeting funds push more capital into the market. That's positive. People are very happy to chase risk when implied vols are this low. So I think that's a good way to look at it. But I still think what's going to derail, from a data point, once we get past the Fed, there isn't much to really go. So it just comes down to flows. That's the thing, that so much of this is now driven by high frequency algorithms and all these factors that and various sort of hedging flows and leveraged ETFs and all these factors that will be driving the market. If the market continues to kick, then that will just, more cash will come in and it will perpetuate the move up. If everyone starts taking profit and the algos sense that, you could see books being closed early. But I think once the data's out the way, the macro sort of event risk will sort of dissipate. We're just purely down to flows, and I think that is where, for people like you and I, Blake, the only fundamental that you need is price.
There you go.
The only fundamental. No, it is. I believe that. I completely believe that. Anyway,
me too.
Let's move on to It's a Setup. Oh, sorry, for the pedantic people out there, that's a setup. Anyway, let's move on to Aussie dollar. Now, I'm having a look at Aussie dollar because I've titled this "The Battler Ain't Battling," because down under here in Australia, people sort of commonly known the Australian dollar as the battler because it's sort of has held up in previous times in hard scenarios. I don't think that's true anymore. It just is just an out and out risk currency, a China proxy. But look at it now, Blake. It's got we're at year to date lows. We've had a year-to-date closing low, but we're sort of just pushing that. We are seeing some buying coming back in as we hit that low, and I think part of that is down to the fact that China just can't get a wriggle on. We saw that initial sort of positive flow after the Politburo meeting. It was a one-day affair. People sold back into it. Again, substance is really the answer for China. We're not going to get that real substance until the NPC meeting, which doesn't happen till March. So obviously that, when tariff risk and a slight weakening that we've been seeing in the Chinese yuan have all happened. But we saw a pretty weak GDP number, and that's really our lowered domestic factors. There's a pretty good chance now. There's a 70% chance implied that the RBA cut rates in the February meeting. Now, I think this is a really big setup because we've got the employment numbers coming through in an hour and a half's time from now. The RBA look at the employment market, above everything else with inflation. We get a weak number there, and I think the RBA will be in a position then to cut rates in the February meeting. The market seems to believe that. A lot needs to go right for that to happen. We've still got a Q4 CPI number that comes out on the 29th of January. But certainly there's the whole heaps of reasons why people have been selling Aussie dollars. The question now, at these levels, does it hold? A breakthrough here would be very, very powerful indeed.
And I got to say, Chris, you called it last week. I didn't see it, and I want to just tip my hat to you. It's it is ugly looking. Woo.
Well, it could bounce. I mean, it's right. Our clients are buying it now. They're all seeing it right, multi-year this massive support level, and they're buying it for a range of different reasons, for a scalp, for a potential reversal, counter trade. But the flows has certainly been the view that this holds, and obviously you know where your risk is at those lows as well. But I think
sure.
for me, we'll say I'd want to see a bit more of a bounce before I went out and bought this at the moment.
Well, employment in just a very short period of time. We're going to be watching that. All right. My first setup is going to be Ethereum. And I actually think that Ethereum and Bitcoin are following a very similar pattern. This week I made a big stink about, the Bitcoin finally making it to 104,000, 103,800. And we surpassed it to 104,000. We backed away. I think you still buy dips below 100,000. Then you sell it. You spin out of it above 100,000. Ethereum, is making this move that I think is going to match what you're seeing in Bitcoin. As long as that channel remains intact, that means while we trade above, let's call it 3,500, 3,550, it seems like we're heading back to 4,100. And I would be buying dips to channel support, selling rallies, and with the idea that eventually we're going to break above 4,100. I still think Bitcoin's going higher. I still think Ethereum is going to go higher as well. And I think it's eventually going to break out. So positioning yourself on the long side on dips, I think makes sense to me as long as that channel holds in place. And that, again, is just above 3,500 right now.
Yeah, cool. Well, I'm going to keep it crypto, keep it really real. I'm going for a bit of Ripple, a bit of XRP. The reason I like this one, Blake, is because I just love those wicks. You have a look at there's really, really, really strong demand from whoever or whatever below 220. Really throughout the whole of December, every time we've gone below 220, there's just been this wave of buyers that step up, and you can see that in the absolute length of the wicks that you can see in that. And I think that's really, really important. So for me, if I wanted to get short on this, I would wait for a daily close below 220, and I think that would give me the conviction that all these people who have been buying, all these systems that have been buying, will be caught offside. They'd have to manage that position, and that could perpetuate the move lower. So you know where your risk is, and you know where to look to square and reverse that position if it comes through. But I love that. There's obviously clear demand. Is this a coiled spring that's ready to explode? That it's early at the moment, but I think if we sort of look, we've seen that demand below 220. We've seen a higher high coming through. I think a momentum strategy is the way to go. So I think if we can see a break, I'll be looking for buy stop orders above 248. It's just above the market price now. And what we're looking for there is a body in motion to stay in motion. It breaks through the highs, and you're hoping it capitulates. All that buying pressure manifests into a bigger move. So I'm leaving buy stop orders above 248, hoping for that move to kick and hope it runs.
Ooh, gosh, man, that's a hell of a dip buy. I like it, Chris. I'm glad we talked about it last week. All right, let's take a look at the euro yen, and that's going to be my last setup. And this is how I want to fade the ECB. Remember, just a few minutes ago, Chris, I said I can't remember an ECB meeting that I walked away from in recent meetings that turned the euro bullish. But this isn't all just a euro story. It's also a little bit of a yen story. There's some headlines out last night about the BOJ. Some expectations are starting to come out of the market that the BOJ is going to deliver next week. Not 25 basis points, but maybe they might be able to hike maybe 10 basis points. Right. Anyway, you're starting to see the yen weaken a little bit. And I think the euro yen has been a really nice setup of a false breakdown below a channel. So as long as it's holding above today's lows, I say today being my day, or the 24-hour low there which was just around 158.75 or so. If we can hold above that tomorrow post ECB, that means basically a dip back towards that channel support. I'd be looking to play it on the long side back up to 162.85, which is the 618 retracement and also the 50 DMA. So I'm looking to buy dips here. I think it's a good setup. And again, it's not just an ECB story, it's also a BOJ story.
Interesting one, isn't it? I mean, we're all getting very excited about the Bank of Japan raising rates by a full 25 basis points. That's now come down to 13%. The Bank of Japan reports in the media saying they're prepared. There's no downside in hanging off at the moment. They don't see any negative effects. But now the January meeting's been called into question a bit as well. So, I think the Bank of Japan, we just perennially get disappointed. We get expectations to come back, and they just sit on their hands. So, it's just so difficult. But I know there's a lot of people getting very excited about the prospects for the Japanese yen in 2025. But Blake, we've been doing this show for a while now, and I think we seem to sort of do the Christmas special of the outlook for the year ahead, always coming out and saying people think that the yen's going to be the play of the year because they're going to be raising rates when everyone else is cutting. And yeah, it sort of, we've seen pockets of strength, but it fails. Anyway, let's move on. The Bank of Japan meeting is definitely one to put on your radar next week. I don't expect them to cut to hike rates in that situation. Let's go to play of the day. I'm going to keep it. God, I'm all about keeping it real today, aren't I, Blake?
You are. You're always keeping it real.
Just man of the people here. Let's go for the Nasdaq because I'm a fan of doing what works. If something's working in your life, Blake, you do more of it. If it's not working, you try and do less of it. You bite your tongue. You don't want to do it again. And that's what we're seeing with the Nasdaq right now. I love the price action. Didn't close at its highs today, but it wasn't far off. Go into the options market and we can see a reasonable premium for calls in terms of the total number of volume relative to puts, and that's reasonably rare. But now we've seen NVIDIA kick, Amazon, the Teslas of this world, they're firing up. And if growth's going to be a place to go, I think this is the market to continue to look at. I like the Nikkei as well. I think we're probably going to see a short-term move up in that. We talked about crypto. I still think there's some juice in that. I talked about what was going on in XRP. I like gold at these levels as well. But I think the Nasdaq now, obviously valuations are ridiculous. Don't care about those, to be honest. I'm a trader. I don't worry about valuation at all. And I do worry that, Blake, that the further this goes, the more that elastic band is going to be stretched. For January, we could have a bit of a sell-off as we come into Trump's inauguration, and that sell the fact on tariffs and various factors. So I do think that the further this goes, the more volatile January could be in US and global equity markets. But for now, pullbacks are a buying opportunity, and I still see the risk, the skew in risk, directional risk delta towards higher levels, to be honest, in the Nasdaq. So I still like this one on the long side.
Ooh, 2025 is going to be a zinger. Can't wait, Chris. And I hope every one of you are tuned in every show next year because it's going to be awesome. All right, my setup, or my play of the day is going to get loony, and it's time to get a little loony. It's time to get a little crazy, folks. The dollar CAD it's had this really, really strong bid. I know everybody's bearish Canadian dollars, and it's got, it's just, every dip has been bought while it's trading above 140. But I'm actually looking to fade this one, Chris, just from a technical perspective. You can see the RSI is very divergent on a daily chart, but more importantly, you can see the 127% extension of both the range of 2020, the October 2022 highs to the 2023 lows back in June 2023. 127% extension comes in at 142.35. Also, when we touched that high following the tariff headlines when Trump was threatening Canada, that moved from that high to the low that was just below 140. That 127% extension comes in bang on right at 142.35. So if we surge to a new high to 142.35, I'm going to fade it. And that is my play of the day. And it's more of a technical play, but I'm still going to fade it. So.
Yeah, very interesting indeed, Blake. Thank you for bringing that to attention. I think next week, let's switch gears a little bit next week. Let's do I think we're going to have a break over the Christmas holidays, seasonal holidays. I'm sure people want to be left well alone during that period. But yeah, I think next week do something a bit funky. We'll sort of have a look at a year in review, and more importantly, what lies in store in terms of event risk, how volatility may shape up, what sort of catalysts could shape our trading environment, what markets we kind of like, where we're looking, the sort of themes that we can play out, and let's call it a Christmas special. Something original.
Maybe some of the viewers at home can jump in the comments below and ask us some of the things that they'd want to see.
Ooh, yeah, please do. That'd be awesome. Yeah, we'd like to hear from you as always. We smack that like button as someone's just put on the screen there. Smack the subscribe button. Why don't you, for Christmas, if you celebrate Christmas, give your family the gift of the trade-off. Anyway, we'll see you back next week. Blake, thank you very much. And for you at home, next week. Bye-bye.